Today we've got a task that's, well, challenging but absolutely vital. We're taking these dense 9M 2025 reports from Selcuk Exadepozu.
A huge player in Turkish pharma distribution.
Exactly. And we're going to try and pull out clear, actionable insights, specifically for you, the individual investor.
It's a real deep dive into the financial health of, a logistics giant.
And maybe the most crucial thing before we even touch a number, context. Selcuk Exa operates in a pretty unique environment, right?
Correct.
Defined by hyperinflation.
That's absolutely right. These results we're looking at, the 9M 2025 ones, they're under TMS 29. That's the Turkish inflation accounting standard.
Okay, and what does that mean practically for the listener?
It means we're looking at real inflation-adjusted numbers. It strips away that, illusion of growth you get just from prices going up. It gives us a true comparison based on purchasing power.
So when we talk about margins getting squeezed later, you need to understand it's a real squeeze, a structural issue, not just, say, high input costs being passed on nominally. Got it. That real versus nominal distinction is key.
Yeah.
So let's unpack the company itself. Selcuk Exadepozu, founded way back in '58 in Konya, now HQ'd in Istanbul.
Yep, Nakashmapüskudar. Their core business is Exadepozu's pharmaceutical warehousing. They're that critical link between the drug makers and the pharmacies, the hospitals.
And then the scale is, well, it's pretty big.
Oh, it's staggering. They run 111 depots across Turkey. You've got 27 main hubs, 84 regional ones, and a fleet of, over 2,300 vehicles?
Yeah, 2,363 vehicles listed. It's pure logistics muscle. Staff count just under 6,000 people, though interestingly, slightly down from the end of 2024.
A slight dip, yeah. Maybe some optimization there.
They seem quite focused, but they do have other interests.
They do. They own almost all of Exadepozu. And the group also has a hand in cosmetics, personal care, medical products, the Atriot market, as they call it.
But that's a small part.
Very small. Less than 10% of revenue or assets, so it doesn't get reported separately. The story here is really pharma distribution.
Okay, and market position.
Dominant. Simple as that. In the first 9 months of 2025, they grabbed about 37.4% of the market by value, and slightly more, 37.6% by volume, by the number of boxes.
Out of a total market worth nearly $500 billion TL.
Wow. Yeah, they define the market in many ways. They also do a bit of exporting North Cyprus, Tajikistan, Azerbaijan, Afghanistan, mostly regional.
Okay, before we hit the financials, let's quickly look at who's running the show. Ownership.
Selcuk Exa Holding A's is the big fish here. They control over 82% directly and indirectly. About 20% is floated publicly.
And the board, the Unitum Kurulu.
9 members total, 3 are independent, but, and this is something you notice, especially looking at governance trends.
What's that?
0 women on the board out of 9 members. It's just notable in 2025. So that's something about the culture, perhaps.
Definitely something to keep in mind for assessing maybe long-term adaptability and their pay.
The report mentions the General Assembly approved the total benefits for the board for 2024, but doesn't break down the specific amount. Typical disclosure, really.
Right. So governance details give us a flavor. But let's shift now. How is this massive operation actually coping with that inflation squeeze we talked about?
Okay, yeah, let's get into the income statement, because this is where you really see the impact of TMS 29 hitting hard. The pressure on core results in real terms is intense.
So top line first. Sales.
Net consolidated sales. They were up, but only just. A 3.41% increase in real terms, hitting about 123.7 billion TL.
Only 3.4% real growth. But wait, didn't you say cumulative inflation was huge?
Exactly. 3-year cumulative inflation was 222% by September 2025, so a 3.4% real increase. That's basically stagnant. They're running hard just to stand still in terms of real revenue.
They sold more stuff, maybe, but the price increases barely matched inflation.
Precisely. And that flows straight into the margins. Gross profit, down almost 15% in real terms.
15% drop in gross profit.
And the gross margin itself fell sharply, from 9.7% in the first 9 months of 2024, down to just under 8%, 7.97% in 2025. That's a big slice off their initial profit per sale.
Okay, that's tough. But what about after operating costs? How did the core business hold up?
Well, this is where it gets quite dramatic. Operating profit, İses Faaliyet Kari, it just collapsed. Down a massive 67.57%.
67%. That sounds, is the core business model even working under these conditions, especially with regulated pricing?
That's the question these numbers scream, isn't it? The operating margin went from 3.43% down to just 1.08%, a tiny sliver.
So inflation-adjusted costs are just eating up those already pressured gross margins.
Completely. And EBITDA, or FEAO, which people often look at for operational cash generation potential, that followed the same path. A huge real decline of over 43%.
Wow.
The EBITDA margin dropped 2 full percentage points, from 4.44% down to 2.4%.
So the cumulative effect of all this pressure.
It leads to the big headline number. The group swung from making a profit 855 million TL in 9M 2024 to booking a net period loss of 565.8 million TL in 9M 2025.
A loss. Over $500 million TL.
Yeah. The net margin went negative, minus 0.46%. So the key takeaway for you is the core pharma distribution business, when you strip out inflation's effects, was actually losing money in this period.
Okay, those are some really tough operational figures, especially adjusted like that. So profits were bleeding. But this kind of business distribution, it's also about managing cash flow day to day, right? Working capital.
Absolutely. And this is where we see their strength, their sort of counter move. It's their trade leverage.
Explain that.
Okay, look at their average collection period for receivables, the ALACAC. They give customers about 78 days to pay.
Right.
But they take much longer to pay their own suppliers. Average days for trade payables, the BORS, is 95 days.
So they hold on to their cash for 17 days longer than they let their customers hold on to theirs.
Exactly. That gap isn't just a number. It's like a constant, built-in, interest-free loan from their suppliers. It's a huge source of liquidity for them.
Mitigates their need for other cash.
Precisely. Now, those receivables are massive, 40 billion TL, but they seem to manage the risk. They've set aside about 172 million TL for potential bad debts.
Okay, so operations were loss-making in real terms, but they have this working capital advantage. Let's pivot to the balance sheet then. How did they use that advantage? What about debt?
Right, and the balance sheet tells a really fascinating, almost strategic story. It looks like management decided to, well, trade some operating pain for much better financial health, aggressive deleveraging.
Oh, aggressive.
Look at short-term financial liabilities. End of September 2024, it was over 9.3 billion TL. 9 months later, September 2025, it plummeted to just 1.93 billion TL.
Wow, they basically wiped out most of their short-term debt in 9 months. That's a huge strategic move.
They paid it back proactively. Remember that cash flow dynamic we're about to get to? They used it for debt repayment. They redeemed a big 3.5 billion TL bond in January 25, then another 500 million TL private bond in March 25.
Okay, so that explains the cash flow statement showing a massive outflow from financing.
Exactly. A net cash outflow from financing activities of nearly 7.9 billion TL. That's a complete flip from the year before when they actually had cash in from financing.
But wait, if they reported a net loss from operations, where did the nearly 8 billion TL come from to pay down all that debt?
This is the absolute crux of it for understanding their strategy this period. Their operating cash flow generation improved dramatically.
Oh, if they were losing money.
Working capital management. That trade leverage we just talked about, they generated a massive 5.84 billion TL in cash from operations in 9M 2025. Compare that to less than 200 million TL in 9M 2024.
So it wasn't profit-driving cash, it was squeezing liquidity out of the working capital cycle. And they immediately funneled that liquidity into paying down debt.
You got it. They shored up the balance sheet while the P&L was under pressure. That huge surge in operating cash allowed the debt cleanup.
And did that leave them low on cash?
Not really. Cash and equivalents did drop because of the payments, obviously, but they still have a very strong liquid position overall. Combine the cash on hand, about 2.9 billion TL, with their financial investments, mostly liquid funds, another 7.7 billion TL. They have plenty of buffer.
And the market noticed this financial strength.
Seems so. After the reporting period, in October, JCR of Russia confirmed their long-term national note rating at AATR with a stable outlook. That's external validation of their financial structure and risk management.
Okay, so a major balance sheet repair job, funded by savvy working capital management, even while real profits were negative. Let's look at the capital structure that's left. Equity.
Their Urzerme, total equity, dipped slightly, down to about 28.6 billion TL from year-end 2024. Not a huge move.
And their philosophy on funding.
Management explicitly states they focus on managing risk, especially those trade receivables, and using a mix of equity and short-term credit to handle the volatile working capital needs. Which makes sense, given what we just saw.
And we have to keep circling back to inflation, right?
Yeah.
EMS 29.
Absolutely. That net loss, the margin crush, it's real, adjusted for purchasing power loss. It highlights just how tough the environment is for this sector. Massive financial strength lets them maneuver, but the core business is squeezed by inflation and pricing regs.
So looking ahead, where are they putting their money? Investments.
Capital spending seems focused on maintaining that operational edge. They're building a new depot in Axaray, renovating others, standard infrastructure upkeep and enhancement for a logistics leader.
Makes sense. What about returns to shareholders through all this? Dividends.
They did pay one. The General Assembly approved a dividend for the 2024 results, paid in April 2025. It was 0.40 TL gross per share.
But did they say anything about the context?
Yes, and this is important. The report specifically mentioned balancing that shareholder payout with increasing working capital needs. Given the negative real operating income, it confirms that right now, liquidity, balance sheet strength, that's priority number one.
Do they get any government help?
Some, yeah. About 151 million TL in government incentives, mostly linked to employment and investment laws. Helps a bit at the margin.
Okay, let's try and wrap this up. What's the bottom line here for you, the individual investor, looking at Selcuk Exadiposi?
Well, you've got this dominant market leader. It's financially very secure, that AA credit rating confirms it. And they are absolute masters of managing their balance sheet and cash flow. That massive deleveraging proves it.
Right.
But the deep dive, especially with that crucial TMS 29 lens, shows a really sharp structural decline in real operational profitability. The margins are crushed. They swung to a real net loss. The core business model is seriously challenged by high inflation and the pricing environment.
So it's a fascinating contrast, isn't it?
Yeah.
Brilliant financial engineering, using that temporary surge in operating cash flow to secure the balance sheet, kind of masking or compensating for the weakness in the underlying real operating margins.
Exactly. They use liquidity management to buy structural security.
Which leads us to our final thought for you to chew on. Okay, they pulled off this huge deleveraging using operational cash flow this time, but how long can that kind of financial strategy compensate for the ongoing severe pressure on their core profit margins before something fundamental has to change, either in their structure or maybe they need significant price relief from regulators?
That's the key question going forward. How sustainable is this balancing act?
Indeed. Thank you for joining us for this deep dive into Selcuk Exadiposi's 9M 2025 reports. If you found this useful, please do like, share, subscribe, engage with the content. We'll be back next time to tackle another set of data.